What's going on, guys? Tim Bratz. Hey, I want to sit down and talk to you guys about a couple questions I keep on getting on social media about real estate stuff, wealth building stuff. And so the first is going to be about cap rates. You know, I think cap rates is one of those words that gets people all excited about commercial real estate, but they don't really understand what it means. And it can be complex, it can be a little bit convoluted, it can be a little bit scary with all the different words that people use in commercial real estate versus residential real estate. So let's define cap rate in this video. All right, so here's the key with cap rates. The first thing is a cap rate is a return on investment. Okay, so when you look at it, it's also known as an unleveraged yield or ROI. So let me give you an example. If you took $1 million apartment complex or commercial building of some sort, and it had a net income after all operating expenses, before debt service, before anything like that, and it netted, let's call it $70,000 a year in net income, your return on investment, if you bought that building with cash, would be a 7% return on investment, right? 70,000 divided by $1 million, your all-in cost, would yield you a 7% ROI, or a 7% unleveraged yield, or a 7% cap rate at your cost basis. So that is all a cap rate is. It's what is your return on investment. Now the part that confuses people though is there's a market cap rate. So we're here in Charleston, South Carolina right now at the waterfront park. It's Charleston Harbor, you've got Fort Sumter out there and whatever that one is too. And then a Carnival Cruise Line. But let's say the market cap rate in Charleston, meaning what do comparable buildings sell for? What are investors paying? What kind of return on investment are they looking for in this market? Let's say it's around 5% in Charleston, South Carolina, a 5% cap rate. So if you buy a building that yields $70,000 a year in net income, on $1 million purchase price, but the market cap rate is 5%, then you have a 2% spread on your project. So let's do some math. If you have $70,000 in net operating income divided by 0.05 or a 5% cap rate, then that means your building here in Charleston, South Carolina, in this market, would be worth about $1.4 million. Because the market cap rate, most things in the area are trading at a 5% cap rate. But your cap rate at your cost basis or your unleveraged yield is a 7%. So now when you make a spread on what that looks like, based on what your NOI is versus what things are trading for in the area, now you have a spread that's a multiple of many times that of how much value that you're creating in that property. How do you create that spread? The spread is created by, first of all, finding off-market, direct-to-seller, and negotiating amazing deals. The second part is creating appreciation through the sweat equity, through the value-add process that you put into the property. Instead of speculating on hoping values would go up tomorrow, you actually create the appreciation by putting sweat equity into the property and increasing the income, decreasing the expenses, and making more of a spread in that NOI. And the cool thing to understand is cap rates are affected by interest rates. So as interest rates go up, market cap rates typically go up as well. And sellers or owners and sellers of commercial real estate, of rental real estate, are typically adversely affected in value because as cap rates go up, values actually come down, right? Because people are spending more money on the interest than they can spend on the actual principal pay down and the purchase price of the property. So as interest rates go up, cap rates, market cap rates go up, which means values typically come down. So in this ever-changing economic environment and ever-changing interest rate environment, there's two things to understand. First is that values are predicated based on what's going on with interest rates. And your return on investment just needs to be a spread. So it's not about getting a certain stabilized value or after repair value on your property. It's about making sure that there's a spread of your cost of capital versus what your net operating income is. and ensuring that your cost of capital is less than what your NOI is. If that's the case, then you can cover your debt service payments, your mortgage payments on your property, and make a spread on it and be able to ride out any sort of economic storm. The second part of that is understanding that sellers aren't going to be able to get their purchase price anymore because interest rates are going up. You can't go and expect somebody to pay a 5% cap rate in Charleston, South Carolina if interest rates are 6 or 7%. Maybe somebody who's speculative would pay that, but any seasoned real estate investor who buys for cash flow would never do that. So now there's this gap that's occurring of buyers who are only willing to come up to a certain price point and sellers only willing to come down to a certain price point. Now what happens? How do you bridge that gap? Well, somebody's either got to budge. Either a buyer has to be so motivated to be sitting on so much money that they need and they're willing to take a lower yield or a lower return on their investment, or the seller has to be more motivated enough that they're willing to take a lower price point and sell it for short of what the previous value might have been when interest rates and cap rates were really, really low. Or you can get creative. And this is where it gets exciting. Like, I love these kinds of environments and as things are changing with interest rates, because it allows me to go into a conversation with a seller and negotiate some sort of seller financing terms. So I can maybe get the seller to carry back the mortgage and be the bank for me, instead of me having to go to the local bank and get a 6 or 7% interest rate loan. I can go to the seller and say, hey, you want to sell this thing at a 6 cap? No problem, but I need you to be my bank. I need you to seller finance this at 4% interest rate. And so I'm willing to pay a retail price for this property if I can get the financing terms low enough from the seller or some other sort of creative financing where it allows me to create that spread on cap rate and create the spread on the cash flow. So if you can understand that side of things and look at the different variables that affect the net operating income, interest rates, financing terms, cost of capital, all those kinds of things, and figure out what those variables are and how you can play with them in order to reduce your cost of capital and increase your NOI, you can get into deals regardless of the changing interest rate environment that we're seeing right now. So hopefully that it gives you a little bit of background on cap rates and on how to attack the changing interest rate environment. If this was helpful, please like the video, comment below what you're seeing in the marketplace and how this can help you, navigate the things that are happening right now with changing interest rates, with the changing market, with the changing economy, and with what the Fed's doing in order to try to hedge all the inflationary type stuff from printing all the money that they've printed over the past few years. But give me some comments in the comment section. Any questions you have about this? Maybe there's something that I could explain a little bit deeper in depth. Put it in the comment section. I'll create another video specifically for you answering that question. So appreciate you guys. Please subscribe to the channel. If this is helpful, please share it with somebody else who would get some good value out of it. And until next time, be your best.